Today, he's here to share those insights and also helps us understand one of the hardest things about building a company, how to negotiate with us, with investors, right? So hopefully you keep notes of all of these tips and use them when you're negotiating with us. So thank you very much for being here, and big applause for Andrey.
Thank you very much. Yes, I will be doing something counterintuitive probably, explaining how to negotiate with us. But as a mentor, I have to be an ethical person, so I'll tell you the truth mostly. First of all, why mentoring and negotiation, like how they live together? Mentoring is about soft skills, as they call it. And that's important to be able to put your knowledge into context. So you can research whatever you want to research online with ChatGPT, Gemini, read books. But when you need to apply it, you most probably will need some help from people who understand how it really works. So let's move forward. One of the rules which is important to remember that those principles work both ways. Meaning that it's not only you using these rules when negotiating. Your counterparty uses these rules the same way. So that leads us to a very simple but powerful understanding. To be successful, you need to understand what your counterparty really wants and how you can address those wants without surrendering your position, at least too much. And the question, again, I would not like to only talk today, I would like to have a conversation. And one of the questions, so what do you think, when do you start communicating with investors? At which time of your startup journey?
At the beginning.
Meaning?
When you started, you think about investing.
Okay.
When you have traction, some sort of traction, so you have something to show for it, like proof of concept, then you can start talking to investors.
When you need the money. Yeah.
When you need it, yeah.
When you need the money, you had already have to be like halfway to those money. Otherwise it's time wasted. I think yes, it's kind of, you're right, because you start with your value proposition. Because as soon as you decide what you do, you already shape your future conversation. And this is what I wanted to say. It would be a mistake thinking that negotiation begins when you sit at the table. It all begins much, much earlier than that. And that would be the beginning point. You frame what you do, you frame your conversation when you decide what you do. And again, be serious, because as we say in Agile, garbage in, garbage out. So, build your value proposition, broadly speaking, attentively. So, what would be the right communication process from beginning to the end? How would you describe it? And that's not a quiz, it's a conversation.
Maybe creating a relationship between both parties. No, it's about trust, about sharing how is your business, and no, it's.
That's good, yeah. Anybody else?
Well, being respectful in the first place, like set the right tone for the investors so the deal go well.
Okay. So again, this is not from the book, this is kind of mine, personal understanding how that works. And if you see, persuasion of merits, persuasion of fairness, it's all about mutual respect. Again, don't forget it works both ways, because a lot in this process is about signaling. If you don't respect investors, they will feel it, but if they don't respect you, there's little value in continuing this conversation. And well, it's also quite simple. It's not about hurt feelings. The standard duration of a startup life before founders can exit is about like 10 years. So it's similar to a marriage or to incarceration in a cell, whatever analogy you like more. So working with people you can work with for a long time, like liking these people is much more important. Because you can get money from people you don't like and you can't work with, and most probably that would be a failure. Because that's not about like or dislike, it's a complex situation. You like or dislike people for a reason. And very difficult to have a productive relationship with somebody who don't like to do that. Again, if we just go here, so with the value proposition, we go to storytelling. And storytelling is a very, very important thing which is fairly underrated. So you need to know how to tell a story. Why? Because to get to negotiation table, you have to get an invitation to this table. You can't force your way in. To be invited to this table so what do you need to do to get invited? Pure common sense.
Be interesting for an investor to invest in you.
Yes, sure.
You have to be memorable also, because they've seen thousands probably of pitches, but a lot of them just fell into forgotten stories. So yeah, I would say stick on the mind of the investor.
Yes, and that's why storytelling is important, because nobody can evaluate you on the merits. We can't physically do it. We'll see two pitches today. Again, I maybe tell you a little secret. We will be looking at those startups. They will be pitching for 3 minutes. I have no viable way to evaluate this company on its merits. Like really. Technically impossible. And they should not convince me that they're so great that I need to invest right here, right now. Their goal is to have a next meeting. Nothing more, nothing less. So when they have more time, and we can dive deeper into what they build. So each of those stages is devoted to a particular goal. You should not go to elevator pitch expecting to get funded. You go there to get the next invitation. So then it's about persuasion of merits, meaning that your investment opportunity is interesting enough to continue this conversation. Then negotiation follows, and then the persuasion of fairness of the deal, that the deal that you offer is fair. And finally, there's an agreement, hopefully. So in storytelling, there are many things that many techniques you can use, and look them up. One of them is the golden thread, and this is how you map your customer journey, identifying the pain points, identifying the blocks, working with them, co-creating with them a different path, a better path, until you're satisfied. Another one is the one that is used in Hollywood. It's Freytag pyramid. Each and every movie follows this path effectively. Not only movie, screenplay, book, whatever. To put a proper analogy to that, I always say the following. Consider your startup as a series, not a movie. A series. So you have season 1 that we present today, which will probably culminate in a fundraising round and initial deployment. When you reach that, season 2 starts. And that's how it goes. That would really help you to build the storytelling, because it never ends. You need to tell these stories to your stakeholders, investors, customers. You need to be convincing, you need to be different, and you need to be interesting. Otherwise, it just doesn't work, because you are kind of analyzed on rational grounds, but perceived initially on emotions. So if it's a dull story, That's a much more difficult sell. So this is how it works, you see. So if we speak about persuasion, there is a classic model designed by Aristotle based on credibility, emotion, and logic. Then Cialdini principles, if you see them, reciprocity, commitment, social proof, authority, lack, and scarcity. So what do they actually mean in the real life? So for reciprocity, it's an interesting concept. It's well researched and well documented that if you, let's say, give somebody a gift, this person feels obliged to return the favor. Did you notice that in you? Or all of you are bad people who just get the gifts and feel no reciprocity at all? So people use that technology in many ways. Even here in Barcelona, from time to time, somebody comes to you and offers you a flower for free initially, right? They try to explore exactly that principle. So social proof, commitment consistency, I think it's quite clear. Social proof is about an inclination to do what our friends or people whom we trust already did. Okay, and guess which segment of economy, digital economy, is thriving because of that principle? The second word is marketing. Which is the first one?
Social?
It's influencer marketing, I think. Because that's all about that principle. It's very, very strong. And you see that it really, really works. Authority. That's when you, okay, like brand ambassadors are the embodiment of authority principle. Liking and scarcity, okay. Let's go to scarcity. That's the famous FOMO, fear of missing out, fully built on the scarcity principle. And if you know how it works, your life becomes easier because you can use it and you see when people use it to you. And when you see that people use it to you, you can build a better response. But it's kind of designed further. And that. So, as you see, the contrast principle, for example, which was not mentioned, is also an interesting one. It's used a lot in high-end retail. So if you come to, I don't know, like Hermes store, and they show you a bag for 20,000, the bag for 10,000 will not seem so expensive. And so they do it on purpose. They always, in that business models, they always have something outrageously expensive to contrast that. And so the other offers seem better. Anchoring is one of the most important concepts actually in persuasion and negotiation, but I think I will leave it until we get to negotiation part. In scarcity is former urgency. It's when they tell you that, like, you know, the sales end today. Take it or leave it. Foot in the door in the face, it's two opposite of the same one. So foot in the door meaning that, okay, if you manage to get something small and it's easy to get something bigger. Door in the face, when they refuse you with something large, you can still get a smaller thing out of them. And novelty and emotion is like, emotion is more about passion, I would say. So novelty is very much used in the startup world. Everybody say we build something novel, right? And that's what is left and right. And passion here, which is emotion, is what they expect you to demonstrate. To be passionate and emotional about your project, that would help you persuade investors. That's one of the things we really look into, because, especially at early stages, because we always evaluate the team first and foremost. The rest is secondary. Another thing is persuasion versus manipulation. That's not very readable slide, but important concept for you to understand, not in a sense that it's bad for you to manipulate people. It's bad. But in terms when you see when people try to manipulate you, which happens, unfortunately, more frequently than we would like. And this manipulation happens quite often when people try to make you accept the terms of the deal that are really not fair. So, if you see, pressure, guilt, fear, cognitive biases, strong emotion. And they use a lot of authority, pushing you, telling you they don't know what you are doing, but they do. So, the ethical test, as they call it, is quite simple. If the pressure is removed and you are happy with this deal, it was persuasion. If the pressure is removed and you see that you will be short-handed, that was manipulation. So that's about what ethical persuasion is. So intent should be transparent, information should be truthful and complete, there should be no deception, mutual benefit and trust and credibility. We spoke already why mutual trust is important. And again, it's not just we discussing what's good, what's bad. No, it's like it works or it doesn't work. Why? And you need to, again, understand it quite clearly, because people who try to behave in an ethical way in the world of startups, in terms of investment, are quite strange people. We had a conversation with one of my friends right before the beginning of this session. In startups, we don't have much, except for the team, which would be working, and delivery was promised. So there's a very small reason to try and to shorthand this team, making it feel that they kind of been duped for them to lose incentive. And that's strange behavior on the part of investors, but it's exactly as dangerous for you. Because if you take this deal, if you negotiate badly, it will end in a way that you will be disappointed, disheartened, lost incentive, and the company is as good as is dead in the water right at that moment. So being unethical is a bad business, as simple as that. I think I won't be showing the videos today because there will be a lot of advertising from YouTube, but we can give it a try. But if it goes like that, we'll skip it. Let's see. Okay, so then a question to discuss. So after what we spoke about, what your pitch deck essentially is? How can we describe it now in terms of techniques that are used and in terms of its goal? Not the structure, like what it is.
It's an invitation to want to know more.
Okay.
Storytelling book.
Yes, and?
You have to show that you're passionate and emotional about what are you like presenting.
Effectively, it's a combination of three concepts. It's obviously storytelling, because good pitch tells a story.
No, you can finish that. I just wanted to say that basically it's everything, but in a short lapse of time with the freedom of the investor. So you have no personal space to speak, but let's see how can you express your ideas, which I think is super important when owning a startup.
Yes, sure. So this is a combination of storytelling, persuasion, and initial part of negotiation. So let's look into that, scroll that forward. And the question is how to avoid this outcome. So this is what happens if you fail. And effectively, it's not our problem as investors if we didn't understand how good you are. But that's your problem. Like, it's really this way. Normally, there are two sides to blame, not in this case. Many times, common mistakes are as following. One of the most common ones is when you are so deeply embedded into a product, into your business, that you assume that everybody knows it on the level with you. No. Moreover, we are not obliged to. So use this 5-year-old test. So if a layman can understand what you are building and why this is good, okay, go forward with it. You'll have time to show your technical and other credentials when and if you're invited for a deeper dive. You'll have your due diligence process, everything, and you'll be able to do it. But at this moment, that's not what you do. You need us to understand. And as we said, we have received, some of us like tens, some of us hundreds of pitches a week, and we need to shuffle through them, and we need to choose the best ones, and it's a difficult and ungrateful job, so you need to make it as easy for us as possible to understand what you do and why this is good, and why this has a chance to scale. Another thing which is important to understand is the game theory. Effectively, I'm not speaking about mathematical part. It's just about the basic concept, like what kind of game you are playing. Is it a win-lose game? Is it a win-win game? Or in other words, is it competitive or cooperative game? And what would be your choice when you're early stage startup speaking with investors? Why?
Why? Because, well, it's attractive to the investor, it's also attractive to the startup, and you have a higher chance to actually have some sort of deal happen or it doesn't happen. Because if it's competitive, then it's a win-lose situation more than win-win, like you said.
I mean, to compete, you need to have resource. And you're looking for that resource, right?
Okay, now that's good. Moving fast where we need to move. How negotiation is structured, yes. Anyway, cooperative game is not only more nice to play, but it's a better option for a weaker participant anywhere. And startups rarely have an upper hand in those negotiations. If you're somebody who dropped from OpenAI, and then they give you $1 billion of investment just because of your name, okay, fine. But that's a rare thing. Normally, startups obviously have a weaker hand in those conversations. And we go back to ethics. So if investors push you too much, then again consider if this is the right partner. They will push you, but there should be limits. Okay, this is an article from Forbes. It has exactly 15 points on how to conduct business negotiations. I think it's 5-year-old or something, but again, if you're interested, I will be happy to share the link, and I made it hopefully visible for you what they try to share, how negotiations should be structured and what needs to be addressed. Listening and understanding other party is one of the key components, again, because to be successful, you need to know what the other party wants. You can't just move forward with your ideas, not listening to what's happening around you, twice as much considering that you have a weaker hand. Be prepared. Okay, I leave it without comments so far. Professional and courteous negotiations are important, and there's a saying which I encourage you to remember. I like it myself, and I always carry it with me. Like, be hard on the problem, soft on people. So you can say something, okay, I understand the situation, like we're also pressed for time or this and that, but this is unacceptable. That's one way of saying. The other saying that you bring me an acceptable deal. You see, message is the same, but the continuation is different. Understanding deal dynamics, yes, and important to remember that if you are in the deal for too long, it tends to kind of just dissolve. Deals need to be closed. They don't stay there forever. First version of the agreement goes together with the anchoring concept. But we will go to that later, that's my favorite part, so I'll keep it for the third. Okay, prepare to play poker, ready to walk away. That's one of the most important things to prepare yourself mentally. So you should be prepared mentally to walk away from the table. If you come there not prepared to do that, but wishing to have this deal, you open the door to accepting something which you should not be happy about. Negotiating by continually conceding has another name, negotiating with yourself. So that works as following. You say, okay, let's make this investment, okay, valuation cap of 5 million. And they can ask you, okay, what's the best you can give me? And you say, okay, 4. But is it really the best one? Okay, 3.5. So, and if it goes like that, you see, they didn't make an offer. They just make you to concede. And very effective technique if you don't know that. Just check for that always. And always ask, okay, what's your offer? Then you have the range to negotiate. Otherwise you don't. Same story, time and have many deals, the dynamics, fixate on this deal agreement alternatives, always have another deal. Like always. Even if it looks really nice, in 99% of cases something will go wrong and it won't look so nice. And you will really be not so happy of not having an alternative on the table. Hang up on the issue. Also important thing. If something is really difficult, you can just say, okay guys, let's leave it for the last. Let's agree on what we can agree, then deal with the difficult stuff. Same as with exams, actually. You take your test, okay, so that I know, that I don't know, I work on that at the last time. Same approach. And that really gives a deal a better dynamic. Because, okay, everybody says, okay, we did everything, we have 2 issues. Very different than to say that we have 32 issues. Out of this, 30 could be solved, right? Real decision maker. That's what they call a limited authority technique. When somebody can come to you and say, okay, finally we agreed, now I need to get an approval from my superior. So, 2 ways to deal with that. Like either you ask them to bring next time the guy who takes decisions, or you can say, okay, I also need to bring my superior and speak with the board or whatever. And normally people stop doing that. But that's what happened. Okay, they say, we did it. Okay, I went to my boss and he told me no, like not 5, we can do 4.5. And you are kind of already made the deal, like it's small things to do. You're really inclined to take that. Just be aware that it's simply a technique to negotiate. Now accepting the first offer, obviously, because everybody has negotiation margin, in different cultures it's different. In some cultures, maybe there is no negotiating margin. Not in Europe, not in America. Right, questions? Letter of intent and term sheet. Okay, get the help of advisors and lawyers, okay? Term sheet and letter of intent, why it's important? Because even very ethical people tend to misrepresent, misremember, and understand differently what was verbally said and agreed upon. That's like rule number 1. Have it in writing. Not to go to court, but to have a common understanding. Again, simple principle, but very powerful. If you don't do that, you'll be in trouble. For sure. So, Very important negotiations. First one, interests versus positions. So, how you understand the difference between interest and position?
Position is a trade-off, and interest what do I want?
The interest is what you want, and position is what, sorry?
Trade-offs, your trade-offs. What do you don't want?
Not exactly.
Maybe.
Position is your public stance, like what you declare. Interest is what you have in mind. Options, how to satisfy those interests, standards for resolving differences fairly. Okay, that's probably the most famous thing for that principle in startup world is the safe. Bcombinator got really tired of doing this job over and over again, so they built a standardized document, which the whole world is now using. And that's a fair standard to resolve the differences here. Or we can refer to, let's say, you can say valuation, we can refer to Crunchbase, how valuation. So to third-party reliable sources or third parties who can deal with it. Alternatives to negotiation, meaning alternatives to this negotiation, have other opportunities, always. And proposals for agreements based on options to satisfy those needs. So, interest versus positions work, for example, like that. So, there is a real interest, see how satisfied, structure your proposal. And that's, for example, a table again. I just did it today to illustrate what the interests are and then how they could be framed with positions. So, when you negotiate with different classes of investors, they have different interests. All of them want to invest, all of them want to make money. But it's a little bit more different than this. So, for business angels, we invest early. And we can, for example, say, okay, we want to invest to a company and then to sell it to VCs. That's our exit strategy. VCs operate differently, and they invest later. And they need to invest in a company with 100, like multiple of 100. By the way, do you know why that multiple of 100 is so important, and what is the target for ARR now in the States? If we don't speak about AI startups, what the VCs are looking for?
Which stage?
Hmm?
Which stage?
Okay, around, let's say, BC.
What ARR they looking for?
ARR, yes.
100 million?
Exactly. Why?
Which amount?
Because it translates with a multiple to $1 billion valuation. The average multiple is 8 to 12. So yes, the rule of thumb, they also check, can you be a company with 100 million ARR, which will translate into $1 billion valuation to be a unicorn effectively. And why? Also very simple. You need to understand how that's played. Maybe different numbers in Europe or other places, but the principle is the same. They operate a fund. Other people money. So to be able to earn money to raise another fund, they need to give a decent return. Decent return meaning like 15, 20, 25% per annum, or like 3.5 to 5 multiple. How they can do it? Considering that half of the portfolio or more will simply die, like 30-40% will be so-so, like 10-20% of companies will really be like star performers, who will be the ones who will give all the return. So each of the companies they invest into has to have potential to be like that. As simple as this, nothing else. But if you are not this company, if you can't demonstrate in the negotiation this potential, you will not be able to close this deal because you don't have the zone of potential agreement. They don't want to invest in a good company. They want to invest in an outstanding company. For good companies, you go here, they have a different story. A lot of private equity companies, if they don't do distressed debt, they do management optimization and synergies with existing companies and portfolio. That's a different game. Corporate venture capital. Just one extra word by they have a different frame, how they operate. The first, what they need is to find new products for their parent company. So for them, making money is nice, but it's secondary, effectively. First thing is to strengthen the business model of the parent company. So whoever we speak with, it looks like they're investors, right? But you should frame the message very differently for them, because the value proposition they look for is very different. 5 important concepts: power leverage, authority, price, BATNA, and ZOP. So for power leverage, again, we discussed it, right? Mostly that's on investor's side. How can you try to turn the table and get back some power and leverage using the concepts we discussed before? What's your best guess?
Well, I think you can make a lot of meetings with different kind of investors, so to create some hype, and this way you can basically make each investor understand that you can go to another one, and also I think investors following each other's decision, so they will all be interested.
Listen out, the same one, yes, exactly, an oversubscription for the round. That's your basically only tool to turn the tables. To make these two kind of strip VCs of part of their power, make your life more comfortable in negotiations. And that's why you need to speak with many people. Another thing, right? Not only alternatives, having your power back. For authority, there's again two-way street. One of them is what we discussed as limited authority. When the counterparty tells you that, okay, I can finally sign the deal, we need to have approval. Another one is to refer to some authority to make you accept the terms, because using that as a third-party referral. But target and reservation price, that's the range that you come to the negotiations. So it's exactly as it's called. So target price is what you want to get. Reservation price is the minimum price that you will accept. And with which price you normally start negotiating?
Higher than target.
Target plus.
Target plus.
You have to have like a wiggle room to drop it, because if you start at target price, remember the principle, never accept the first offer. So that's how we work as humans. Yes, we complicate our own life, but what can we do? Okay, so what's BATNA, what's ZOPA?
BATNA is budget, authority, time, need, and...
No.
Best alternative.
Best alternative to what?
Is the best alternative option you have.
It's best alternative to negotiated agreement.
Yeah.
Fully say. And ZOPA?
The minimum, the maximum,
It's again zone of potential agreement.
their target and your target.
Yeah, how they intersect, exactly. So what's important to know about these two? They're really key to negotiating. That was a video about power and leverage, so you can have your full homework watching Michael Corleone delivering a lesson on that. That was about limited authority, and this is about BATNA now. So first of all, BATNA is not in this negotiation. This is alternative. It's outside. It's something different than what you can do. So for example, you have this deal with valuation of 10, and you have a second offer with valuation of 9. You speak first with the 10, 9 is your BATNA. Reservation price is based on BATNA. Effectively, reservation price should be higher or equal to BATNA. Normally higher, because if they're equal, you don't account for costs. for going to the second round of negotiations with other people, all the uncertainties involved, all the costs involved, delayed funding. So normally they're not equal. Normally reservation price is higher. Better to have more than one button for sure, just discussed it. Don't disclose it, because first of all it could sound hollow, like I have other options. Everybody has other options. But if you're serious about that, if you run negotiations in parallel, yes, as a kind of the last resort to save these negotiations, you can say, yes, really, I have another term sheet with 9, if you don't agree here, I go there. But you do it once. It's kind of your nuclear option. You don't use it all the time, it completely loses power after first use. And yes, don't forget to account for time and expenses. So, ZOPA is as simple as that. It's intersection of your target and reservation prices with your counterparty. So, if this one does not overlap, so if the situation is different, like they end here and they end here, and instead of ZOPA, we have an empty space. If you identify that in negotiations, you need either leave or reconfigure your offer, because if this is the case, you can sit at the table for a year. Nothing will happen. This is why you need to know what people really want.
How do you know when you're in a position of the ZOPA where like both parties agree on some kind of like made an agreement? How do you know?
If you speak for 3 months that you want valuation of 7 and they continue to give you 5, most probably you are in this situation. So if you stop moving in the direction to each other, then this is the situation that you have. And you need to think. Either you need to kind of move in that direction, or you need to restructure the deal, add some sweeteners, understand why they use this position, okay, have an honest conversation, why, whatever. But you need to unblock it. Because having conversation like round after round, like 5, no 7, 5, no 7, 5, no 7, it's kind of not neither interesting nor productive. You see we blocked, you need to do something. As we see, we start with interesting positions, could be in one space, you can split it in 2. But again, this is not the to-do once, right? That's kind of same as research wall. It continues to add data to this document. But each time, for each round of negotiations, you prepare that. Obviously, you know everything about yourself, right? So the left column could be completed fully. The right column initially has your assumptions, and then you fill it gradually with data as you progress. So, for example, what's the VC button? Investment into other startup. Okay, which startup? Do they have many targets like us? Are we the best fit, or are we one of many? Are we better or worse? So that needs to be researched. And it's not open information, yeah, it takes plenty of effort. So we know their position, right, when we start speaking with them. Okay, understand what their real interest is. For example, as you probably know, VC fund is structured as following. They have a period to invest, then they have a period to divest, some extension time if they can, that's it. So, as an example, they could be at the end of their investment cycle and still don't have enough targets to invest, meaning that you get some power and you can kind of push a little. Or they could be at the very beginning, so they have no rush. Even this matters. So for reservation price, targets, sources of power, weaknesses, so that's all that you need to follow. You need to understand what you do, and then you have your opening move, other information, contingencies, whatever it is. And here we can speak about, finally, I think, anchoring as a concept. What does it mean? That means that you make the first move, normally, and say what you want. There is a research quite extensive research, which says that if you anchor, you normally get better deal than if you don't. Psychologically, it works as following, and it's kind of a filter at the same time. If you don't make it like an outrageous offer, which is completely unrealistic, and people will just write you off as a lunatic, you just make an ambitious but still reasonable offer, they normally tend to accept it, so even subconsciously, as the position and start adjusting to this number, unless they know how it works and can counteract. Normally, proficient people, they don't care. They have a number in their head, you say 10, they say 1, okay, then you can see each other, shake hands and start speaking seriously. But in many cases, anchoring works pretty well. And this is why I always advise to put the full financial ask in the pitch deck. Because again, there are two schools of thought. Some investors would tell you, like, don't do that, just say how much money you need and negotiate later. For me, this is a mistake because it's not about pitching, it's about persuasion and negotiation. This is simple anchoring tactic. And that's how in your pitch deck you start negotiation. That's your first negotiation move. Announcing what you have. Please.
Sorry, you suggest to propose desired valuation in pitch deck directly?
Yeah.
Okay, with some gap, right? Like 50% gap from desired.
No, pitch deck is again, it's 3, 5, 1 minute, right? So what you say effectively is, okay, we raise 500,000 with valuation of 5 million. And we will spend it like 35% here, 50 here, 15 here. End of story. That gives investor immediate understanding. Is it within the boundaries of rationality? Do they want to continue or not? Otherwise, you will spend valuable time devoted to questions. For the question, what's your valuation? Again, you need kind of to be asked exploratory questions at the question session, not confirmatory questions, because that's waste of time. So this is what you need to bring home from your failed negotiation. That's what in marketing called non-customer feedback. And this is a very valuable piece of information if an investor shares with you why they didn't invest. There could be less valuable things saying that it's not on our investment thesis, which will just signify that you did not do a homework and you need to do a homework next time. Well, they can say, okay, valuation is too high or too early, and if this is conversation, you can also ask, okay, when would you invest? What would you need to fix for you to consider us again? Don't just walk away when you hear no. Collect this information, because this is ultra important. That's how we fine-tune your offering and make it better than it was. That's need to adjust your deal to market. And almost no one asks me why you didn't invest, why did you refuse. Those who ask, I will kind of mark them for the future, because they know what they're doing. And just again, it's not kind of ultimate information, but this is a data point to consider very seriously and adjust your value offer accordingly. And the final one is that perseverance is not stubbornness. It's two different concepts. You have to persevere. It's a hard journey being a startup founder, but don't be stubborn. Listen and hear. That's two different words. One thing is listen, the other is to hear. Hear, process what you heard, and then agree or disagree. Not hear. And be open to learn, to change, and to do it. Thank you. Questions? If you have some, let's discuss.
stage, a lot of things are make sense to me. And I would like to ask a question which is in practice, honestly. So right now we're in the digital world. We have like online presentation with the Zoom. We have offline, face-to-face. Is there any difference, or you can give some hacks or for the startups? What is the better way to go through the face-to-face? Try to negotiate with the investor like face-to-face, or it doesn't make sense? And whenever we're speaking about like Zoom, for sure, because for example, we're targeting US market, is there any difference? One of the key questions when we're face-to-face or where it is Zoom, and any techniques and tactics.
Actually, the biggest difference is if you present or if you send your pitch deck to read. That's the biggest one, because that's two different documents. Like you need to have two pitch decks at least. One that you send should not be so graphic. There should be text, because people are supposed to read it. This one, like this pitch, I am following that, right? That's more a plan for me what to speak about than a content mostly. But when you send it over, you're not there to speak. So that comes heavy with text, with numbers, whatever. In terms of Zoom or personal, obviously when you do face-to-face, you see body language. Much easier for you to gauge the reaction and adjust. When you're on Zoom, you see just face, and that's difficult, really. And it's difficult to overcome, so it's only experience. But it's more or less the same as doing the presentation. In kind of face-to-face, at least the deck is the same. It's a visual deck with just a few words because you are speaking, you are presenting, so it's the same thing.
Thank you.
You're welcome. Did I answer the question, by the way?
Yeah.
Thank you.
I have one other question. You mentioned before that when you spoke about persuasion techniques, that you get used to it and you train yourself. That you train. Hello? Well, I'll try to speak loud.
I can lend you my, it's not expensive.
Thank you.
Sir. So I said you mentioned before when speaking about persuasion techniques that you as an investor get used to it and you build like this protection mechanisms. So for me as a founder, a lot of times I think about this, and this is a personal matter, that I don't know what line to not cross to actually to make those techniques detectable, to say somehow, because I don't want to come across as someone who's trying to make techniques to get into you. I don't know if you guys actually like it or not.
What we don't like is empty overpromising. That's for sure. So when I hear for thousandth time that we will crush this market, do this, do that, and then, okay, crush it, I'll go and see it. What I expect from you, and maybe I think many of my colleagues expect, is first of all your relevance to what you are doing, right? Like if you're kind of a trained cook, why would you like to build an AI startup? So you need to see the relevance. It should come from your lived experience normally, right? So if it's something out of the blue, it's kind of difficult for us to pursue further because, okay, why do we do it? Because of the hype? Fine. So maybe I also want to fly to Mars, but even Elon Musk can do that now. Okay, let's wait. So relevance, quality of the team, again, the same storytelling, how you encounter this problem, how you understood that this problem exists and pain is large enough to justify building a business. So what was your path? How you approach that? What? So use the same technique. Use Freytag pyramid, build your storytelling, but be relevant. Don't overpromise. That's very important because we don't want to see the hockey sticks. We don't want to see the revenues of like $1 zillion on the third year. Like please don't.
Thank you very much. And sorry for extending myself. I'm more interested also in knowing like the process before meeting the person, because I think when you already have the chance, things become easier. But when you guys see someone who's like trying to make his way onto you, how much do you like or dislike that? Like he's applying like techniques to scope you.
No, if I see that it's just techniques, there's no substance behind it, then it's a no. So if you approach me with something interesting to myself, then it's probably yes. I actually had an interesting call on a different matter with my supervisor for my thesis. She was laughing a lot because I got another application to supervise a student, and student in BBA, by the way. And he told the doctoral school that he wants me to supervise him. I said, okay, let me read it. And I get this application full of my quotes, which I never wrote. So, imagine, right? That's an extreme example of doing it wrong. But if you try to approach me, okay, I'm getting cold emails, okay. We checked out, okay, my company is called Alchemy Ventures, okay, we checked out Alchemy Ventures, you are so good, this and that, and I know that I didn't do that. End of story. So if it's a quality research, if people come and really kind of demonstrate that they have interest, they checked what we're doing, that we are compliant with what they want to build, they explain why, then it's a major plus. So again, substance. If you just try to check the boxes to build to kind of gauge my interest, or to kind of drive my interest to that, it doesn't work. I'm not so stupid. And if I'm so stupid, I'm of no interest to you. So it goes both ways. So techniques are good, understanding is good, but it should be substantiated. Simple techniques will lead you nowhere.
Thank you very much.
Thank you very much for your presentation. As a machine learning engineer and AI engineer myself, I'm planning to do a product and potentially maybe raise money, but after maybe having some traction, so I understand what I do with this money, right? But you said that there is like different multiplier of IRR to estimated capitalization for AI companies. And would you please extend a bit about this? So what's the situation with startups working or researching artificial intelligence? Is it like better conditions, or is it harder to raise money? So can you share about this?
I would say it's easier probably to raise money. All other things considered equal if you're an AI startup. Same as it was before for big data, before that for machine learning, before that for internet, and it's always a buzzword. In terms of valuation, the big difference is with the foundational technologies, right? We all see those rounds with like extremely high valuations, but this is the enabler of the whole ecosystem. So if you are an AI of a second or third layer, it's not so kind of, you have some of that shine, but not so much. And in my opinion, it will level out in a year or two, because AI will become just an enabler, like internet. It was like, I'm an internet company, right? In a few years, it stopped being kind of a differentiator. Everybody became an internet company. It's not kind of a competitive advantage, it's a competitive disadvantage not to use AI. So this will work like that, and you will be again kind of based on the merits of what you're building, rather than on the name that I'm an AI company.
So basically you mean that, for example, if you do some foundation models, then you have these very good potential conditions, but if you're just using APIs to build the company, there is no difference.
Correct, because again, why they pay so much for foundational models? Because in their evaluation models, they include very rapid growth for those companies, which is not visible today. If you remember, for example, Facebook initial public offering, I think it was 100 multiple was to earnings or something like that, completely crazy on the face of that. Because all the models forecasted rapid growth of that platform, and same story but on steroids happens with AI. So all the models assume that what we see today is just, very, very beginning of that. And that's why they give them this high valuation on expectation of further growth. For everybody else who will be just using AI, okay, you use AI, fine. What else do you do?
Thank you.
You want to cut my throat or what to this side? Not first, please.
Last question here. We're going to have networking later on, so you can ask.
Okay. Sure.
Hi, Andrey. Thank you very much for the presentation. It was tremendously insightful. I wanted to ask you, when you consider investing in a startup that's specifically in seed stage, what is it that you personally look for in the idea, the team, the technology? What are the main decision-making factors?
Three things. Look at the team, as we just discussed, quality, relevance, and if all the key points are covered with the founding team and key employees. And if something is not covered, if they have a plan how to do that. Second thing is predictive analytics of the competitive market. I personally hate positioning maps because they lack the fourth dimension of time. You can if you compare today what you plan to build in 3 years with what people have today. So it's not very useful in terms of understanding competition. So predictive analytics, while they will still be relevant in like 1, 2, 3 years time, considering these competitors, while they won't be moving in the same direction. And third, go-to-market strategy. Do you know how you will be selling what you build? So that's three big things, and then the rest is complementary.
Thank you.
So based on your answer, I assume that you don't pay so much attention to traction, right?
We speak about early stage companies. There is no traction.
Okay. So
for round A and further, of course, you will be looking at the numbers.
Okay, but if you look on a team, right, and team doesn't have any big names behind it, like it's not from OpenAI or Facebook or something, no previous exits, what's a way for team to prove that it's worth to invest in rather than traction, like what it can be?
It's not about big names, it's about your relevance. Okay, if you build a biotech, I expect you to be like PhDs in biology, right? Plus somebody like senior in AI, most probably, because it's now moving in the same direction. I'm speaking about this. I'm not speaking about big public names. I'm speaking about that this team can deliver what they promise to deliver. Like their capabilities are enough professionally, technically, technologically to do what they promise to do. Just that.
Thank you.
All right, unfortunately, I have to cut it now, but big applause for Andrey. All right, Andrey, thank you very much in the name of Bcombinator.
Thank you.
If you haven't been here before, you know that this is not